Hey everyone, I'm Kim Strand, Managing Director at Fiduciary Trust International. I'm here with Erick Rawlings, who heads up our manager research group, and he's an expert in all things in asset allocation and alternatives. Today, we're going to be talking about some of the pressures that have been building in the traditional asset classes, namely stocks and bonds, and really how this may have the potential to restrict performance heading into 2026. So, Eric, why don't we start with really how have these pressures been building? What have you been seeing?
Yeah, hey, thanks. Great to be here, Kim. So there's a couple of areas that we can look to. First is the concentration in the US equity market, where today we are looking at a market that is concentrated not only in the specific names. So here we see a chart of the top positions, the top 10 within the S&P, comprising 40% of the total market cap. Um, but we're also seeing it in concentration of themes. So if we look at those names, we see NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, Alphabet really keyed in on that AI theme. So not only are we concentrated in terms of names, like count, we're also concentrated in theme as well. Um, Another area where we're seeing some of that pressure building, as you noted at the start, is in the valuation. So if we look at uh, the forward PE multiple on the S&P 500, we can see that we have reclaimed that peak that we saw back in 2020 and 2021, and we are nearing the notable peak that we saw back in the late 90s and the dot-com era.
Cool, thanks, Eric. Now, taking all this into account, we've got thematic and stock-specific exposures, PEs, almost, off the charts there. How does that translate into that traditional investment portfolio, that traditional 60/40?
Yeah, the impact that we're seeing is on something that we call single point of failure risk, where um, for the portfolio, as we talked about, with a concentration in theme, concentration in names, and elevated valuations, at the same time, we are seeing a move lower in interest rates, so limiting that return on cash. That means that a portfolio can't rely so much on that yield component, but then is more reliant on those small subset of names to drive on that thematic outcome. And so that's a highly concentrated bet for a portfolio to be making. Um, so what we want to try to do is think about, well, can we create that same sort of average expected return, but use all of the tools that are available to us, really with the intention of reducing that potential volatility. What if interest rates move lower than we expect? What if AI takes longer to monetize than people are thinking? Um, and so when we think about the full toolkit available to us, we start moving beyond the um, just the stock and bond discussion, or stocks, bonds, and cash. We can start thinking about ways to generate uh, that equity return through other asset classes. And so we would think about private equity, where we see a more favorable valuation relative to public markets. This would only improve as we think about secondaries transactions, where you're buying existing portfolios of companies at a discount to that stated value. So it's sort of a discount on a discount, but you're still expressing and gaining that equity-like return that we would expect or are trying to achieve for the portfolio. Um, the other aspect that we can think about is trying to diminish or limit the amount of volatility that we're assuming in a portfolio. It is a portfolio with the same average return but less volatility will compound at a higher rate than a comparable portfolio with the same return but higher volatility. That is the math of compounding. So again, it's, can we use the full toolkit available to us to generate that target rate of return, but in a way that reduces that volatility? And so if you think about fixed income, and we've had some moves and volatility around that. We started the year with the 10-year rate at 4.75. We're now down below four. Um, Not too long ago, we were at a 10-year that was below 1%. So we've seen a lot of volatility through in the fixed income market. So then it's, are there areas where that we could look to help dampen that volatility and be a complement to that fixed income allocation? And then for that answer, we look to the way we go about hedge funds. So thinking about them more as an absolute return, low beta, low correlation to all the other asset classes, and trying to generate that cash plus kind of return on a consistent basis. And they've shown an ability to do so with a more consistent volatility profile.
Awesome. Thanks, Eric. And my last question is, you've talked a bit about this, but what should investors do about this? So, thinking outside the traditional asset classes, we've got fixed income, hedge funds, we've got private equity. Is there anything else outside of that you would think about, or how do you scale into some of these asset classes and think about it from a total portfolio perspective if you've got the 60/40 already in place?
Yeah, yeah. So I think hedge funds are a little bit easier to execute. We think there's a few good liquid options out there in mutual fund format or UCITS format, and then through a private vehicle, you could gain that exposure relatively easily. For private equity, that does take time to build that portfolio. We think about that on a regular cadence of allocations over a 5-year period to build that. But as we were talking about, we think secondaries in this current market environment is a pretty favorable way to get exposure. And there are ways of getting that both from a traditional drawdown structure, but there's also some public or more liquid versions available for particular investors that we would look to.
Perfect. Any other parting thoughts as we think about asset allocating outside of the traditional asset class?
I think for us, they are alternatives are tools in a toolkit. And if we're trying to generate the best outcome for clients and do so with the least amount of volatility in getting there, we really want to make sure that we're using all the tools that we can to achieve that. No one alternative is the solution to all troubles and challenges in a portfolio, but we think when you start bringing them all together, you can really craft a better portfolio to lead to hopefully better outcomes.
Awesome. Thank you very much. Again, I'm Kim Strand, and this is Eric Rawlings with Fiduciary Trust International. See ya.